a moment. I need to manually click the Instagram thing. And I can see that people are starting to pop in here, which is great. And hit that button there. All right. So we've got John Hannum on with us today. We're going to be talking about construction businesses, how they're a little bit different maybe than other kinds of businesses out there. And we're going to be talking about buying these businesses. We're going to be talking about operating them. We're going to be talking about pitfalls. It's going to be a great show, and it's going to start right after the intro.
I'm David C. Barnett, and you're tuned in to Small Business and Deal Making, the podcast, YouTube channel, and blog where I talk about buying, selling, financing, and managing small and medium-sized businesses while controlling risk. So if you're looking to take control of your future through buying a business one day, or if you already own a business and you're looking to grow or exit, you've come to the right place. I talk about interesting things, I talk to interesting people, and I answer your questions every week right here. So be sure to hit like and be sure to hit subscribe, and let's get to it. Are you thinking of growing your business or beginning a journey into entrepreneurship? Take a shortcut to success by buying an existing and profitable business the right way. Visit businessbuyeradvantage.com and learn more about my online training, group coaching, and consulting services designed to help you win.
All right, John, welcome to the show. How are you today?
I'm great, David. Thanks for having me.
Well, it's great to have you here, and it's great to see so many people in here right off the hop. In fact, we've got Kevin from Lakeland, Florida, is already here in the chat as well. We've got Melody, who's joining us all the way from Argentina. Hi, Melody. And I can also see over on Instagram someone with NYC in their handle. So there's someone here from New York probably as well. John, today we're talking about construction businesses, and you've got a big background in this field. I'm wondering if we could kick things off by getting you to introduce yourself and tell us a little bit about your background and how you became, a leader in this space.
Yeah, thank you so much. My background is operational finance, both in the manufacturing, retail, and then also construction space. The last construction company, or the last company we did the bell at the NASDAQ for, was a construction company. So definitely a big passion of mine. That company we took from about 200 million to 400 million within a couple of years, and combined it with another company to take public. So my background is in putting bigger businesses together to make even bigger businesses. And early in 2020, I was consulting with a consumer products goods company that, when I was between work, realized that small business they don't have those tools of finance. They don't make decisions with the tools of finance. So they were making silly decisions and things that their CFO never would have allowed them to do. That set me on a course to bring finance to small business. And that's what I've been doing for the past 5 years.
So their CFO would never let them do it, but these businesses, of course, didn't have CFOs.
They didn't have CFOs, yeah. So the owner used their gut or their intuition, which is great, but intuition with a spreadsheet behind it is a lot better. So
yeah. And so, can you give us an example of one of these decisions that you might have seen that you would categorize as being silly?
Well, in this case, the first company I consulted with was actually a cultural issue. The owners, were all kind of suing each other and had death threats, and it's really non-finance issue that we solved by one of the partners buying the other two out, which was a very reasonable decision. You probably shouldn't be running a company with people that are threatening to kill you, or vice versa. So
yeah,
that was my kind of entrance into that world. But what I quickly realized was that they weren't thinking about costing and product costs. They just knew what the market was, and the product was amazing, but they had no structure behind it to think about how to pull the profitability margin, the levers, and make the profitability better, sell more, or do something interesting with it. So that was just organizing their budget. They had no budget. They didn't know what they were going to sell that year. They just, every time they got to a 30-day supply, they ordered 60 more. And
what when we talk about construction businesses, like the thing that I'm going to probably have in my head during a lot of this conversation would be like a business that's building houses or something, right? Because we're talking about a project. It's going to take a few months, but most houses are built within a year, right? So they're going to be within one accounting period, likely. It can kind of make a business different than, say, a project-oriented business that's putting up a big condo tower, because that obviously can take many years, but we're probably not really talking anymore about a small business when we start to talk about those bigger kinds of projects. What are some of the things that people should be thinking about when they're buying a business like this? Like, I would imagine that, from my own experience, many of the people who might consider buying a construction or project-based business have some kind of experience in that industry. So maybe they've been involved in doing the work, like delivery of the project, or they've been involved maybe in the costing or estimating or something like that. What are some of the things that people should be thinking about when they're even looking at these businesses to determine whether what they're looking at might be suitable for acquisition?
One of the things that you mentioned there was kind of working in that business. So I work with people that come up through the business, and therefore they're really specialized within that industry, within that contractor codes, for example. So they really know that part of the industry really well. That's a great way to do it because you already know how to operate the business. Um, I would say when we talk about contracting and contractors, though, the general contractor that's building a house is really the smallest, I think, piece of that. So, there are really large construction companies that build multifamily and huge projects. There are home builders that build things on mass scale. But most of the businesses in the construction industry are actually subcontractors in a particular field that work for and with those general contractors. And so most of the companies that I see for sale are within their specialized contracting space, and they work with companies that are much larger. So pretty easy and better to run a company that's running, $5 to $25 million in a specific thing that you know how to do. And then you work with general contractors. One of the things I had to learn pretty early on in contracting was that general contractors don't usually build anything, which is counterintuitive. A home
Yeah.
builder home builder has inventory of land, and in order to sell their land, they have to go through the hassle of putting something on the land that makes it more valuable. So they end up contracting that as a project manager to 100 different subsidiaries who all build their little piece of it. I don't think Toll Brothers owns a hammer, really, when you get down to it.
Right. So the businesses that we'd be looking at then more typically in the construction industry might be like that foundation contractor
Mhm.
who now we're shortening this even more. Instead of thinking about a house being built within a calendar year, we're thinking about how many foundations might be built in a month, for example.
Correct. And so if you are the general contractor, you're going to think in terms of many months, but you're a project manager. So you're subcontracting out. The flooring has to be done at this time. The framing, all the different pieces of building that house have to be organized. So effectively, as a general contractor, you are a tradesperson that has to know all the trades, but you're effectively a project manager that's coordinating most of the things and maybe has some labor to do things in between. As a subcontractor, you figure out where you lie in that schedule, and it's like a factory. You just keep doing foundation after foundation after foundation, or roof after roof after roof. And it does allow you to do some of that job costing that we're going to talk about today. That's interesting. It allows you to just have a project that repeats itself, a template that repeats itself, estimating that repeats itself, and you become a really specialized. You know exactly what you're doing in that space.
And so if it's the same stuff over and over again, typically, where do people get themselves into trouble?
I would say the number one place that people get themselves in trouble is just not knowing their cost. You'd be surprised the number of businesses we look at, especially when we go in to buy a business, that just don't do good job costing. Their margins are all over the place. There's a concept called WIP that hopefully anybody in the construction space is familiar with. And it's literally just the amount of money you have in a project that you haven't billed yet, or the amount that you've billed and haven't done yet. You could have a negative WIP or a credit WIP. So that concept is super important. When you talk about even just super important on a huge project, we had with residential design services, we had projects that would last about a year, and we'd have to buy all the flooring up front and then install it over a year in this massive tower. So you talk about $5 million worth of flooring. You got to put out $5 million at the beginning, and then all of a sudden, you can start billing that over an entire year. Means you have to have $5 million of liquidity at the front, and you have to have good billing practices to know what your margin is at the end.
And WIP stands for work in progress.
Work in process.
And it's an important concept when we get into accrual accounting. which is basically the idea that you need to recognize things happening in the period in which they happened. And so you can do work on a project in December, meaning that you've invested in a project and you've got some value in labor and materials into it, but you may actually only invoice that customer in January. And the value was created in December, not in January. In January, it turned into a sale. Now you got a receivable. Where I see a lot of businesses in these trades get into trouble, especially smaller ones, is when they take the easy path and they go into cash-based accounting, because it maybe is less onerous from a paperwork point of view, but then they kind of lose visibility into all of this stuff.
Well, let's look at that example that you said, right? We have you buy all the materials in December and you do all the billing in January. If you have a $5 million job and you buy all those materials, number one, you had to have liquidity or you're just gone broke buying your materials, and you don't get to bill until the end of that process. But if you stop and do your P&L, your taxes, all the things, it looks like you have a $5 million loss if that's the only thing you did. Now, if you did other things in the year and you buy that material for tax purposes, you could offset some of your gains and pay less tax until you bill the $10 million next year, and then you figure that out. But really, if you have a $5 million cost and a $10 million revenue, you should be making $5 million. And no matter what period that's in, you should record it as 10 million top line, 5 million, and then a gross margin of 50%. And that's where people really kind of go wrong. They look at it and say, I had a minus 100% margin in December, and I have all this massive income in January with no offset. Accrual accounting just marries those two up and makes the entries so that that $5 million goes to WIP, comes out of WIP, and you can see very clearly what your profitability is. The number of companies we look at in the quality of earnings and due diligence process where margin might be variable between 13 and 88% is astronomical. It's crazy. And what is that? They're making 40, 50%. It's a good margin, but in months where you're making minus, it's not.
Yeah, they're just not recording these things in the proper periods. And so
Yeah.
it creates this roller coaster lopsided kind of looking performance, when in reality, they might be doing relatively the same sort of performance on every job. It just doesn't look that way on the financials.
They could. And the worst part is they don't know what that performance is if they're not doing the job costing. If they're estimating everything at 50% and only making 45, because on average, everything's averaging out 45, unless you actually do the job costing, you wouldn't know that you're losing 5 points there.
Yeah. Yeah. And so this transparency in the numbers, I would imagine, for someone who's looking at a business to buy, you mentioned their quality of earnings. So you guys do CFO work at PPS. And so you've helped people do this before. What do you end up having to do sometimes? Do you end up having to actually go back and sort of recreate the financials from scratch based on what you can, rely upon from the numbers that you're given?
We do. Our attempt is usually to redo the accounting so that we can get to job cost. If that's not available to us, we still have to figure out how to pro forma or estimate that so that we can get a good set of financials that looks reasonable. It's very difficult when we don't have the job costing done by the system, so you do have to make some assumptions, but it's not difficult to go in and figure out what they should look like if you have the detail and the data. So.
Okay. So we've been talking here about financial statements, and financial statements are typically for a period in time, but you also mentioned sort of job costing. So in a lot of accounting systems that these construction businesses would use, they try to tag or attach, all of the expenses to particular projects. And my guess is that the reason that people want to do this as accurately as possible, so they can look at every particular job and say, how did we actually end up doing on this job versus what we budgeted? Yeah, and do you find people do a pretty good job at that, of lining those things up? And how do you know if there's stuff that's just missing, that falls through the cracks?
Well, these are all great questions. So if we were building our system from scratch, we would start with a job costing estimation, right? We'd start all the way back at the very beginning, and we would say, this is our estimate for the job. If we use that estimate as a basis for, starting to budget the job and then plan for materials and use that information to go through the whole system, we have a better chance of success. So we have a job, it has a job name, we know what the entire budget is, And then we add the element of time. In the first period, we might buy materials. Second period, we have labor, whatever that looks like from an accounting perspective. We start applying those costs against that job. And then at the end of it, no matter when that job ends, we can look at it and say, here's how we did. Our estimate was this, our end was this, and here's the delta. Were we over or short on cost? Now, if you have every cost go into your system with a job name, then it's, you're probably not going to miss too many expenses, right? Because you're not going to have this bucket at the bottom that just has no job cost to it. So that's the way to control, making sure that all your cost gets into a particular job. If you have a variance in the job, you've had extra expense, you have to analyze that against the estimate and just say, where did we spend more than we thought? Could it be an accounting mistake? Did we put the flooring for job 1 and in job 2? Then we just fix it and move on. But we know if we really did spend more, then we look at that and say, okay, our labor rate, for example, is double what it should be. Now we need to go back to estimating and say double the labor rate. I had this in a roofing contractor that had some workers' comp issue. We were looking at, in the olden days, the good old times, it was 25% workers' comp rate. And here in California, it got up to 0.96 on the workers' comp rates for roofing in particular.
Sure, dangerous kind of work, right? People could.
Well, but it literally means for every dollar you give to your employee, you're paying 96 cents to the state. You double your labor costs just by one type of insurance. So, if you didn't estimate, if you estimated at 25%, you're sunk. You've just lost money on the job. So it's super important.
Hang on. Yeah, contractors in California are paying the state as much as they pay their employees.
For a short time, a year and a half ago, that is true, but it's still a significant portion.
And so this is changing, right? Like these rates go up and down depending on the amounts of claims and some actuarial stuff that probably goes into all that mix as well. And so what you're talking about is an important cost that is not constant. So you've got to have some kind of feedback mechanism in here so that the people in estimating know when these things are changing. You're talking about a business management system that has to be applied here.
Feedback loops are super important in all of budgeting. So when you have your estimate, you have to look at the actual and understand why the actual is different. If you have a cost underruns, if you have cost decreases, not so important to get those back into estimating unless it's costing you jobs, unless it's costing you, in your bidding process. But if you have negative variance, you're spending more than you thought, you've got to get that information back into your estimating. Otherwise, you're going to continue to lose on each job.
So if I was going to look at a business for sale and I met the seller on a Saturday and we were there and we saw, oh, look, here's our backhoe and, here's our equipment and stuff like that. One of the things I might want to say is, hey, can you walk me through this process on the computer screen and show me where you estimated a job and how you record the different expenses and what the sort of post-mortem analysis is? You should be asking for that kind of thing just to see what kind of systems they're running.
They are. So normally, if I'm working with a buyer, by the time they actually meet and see the backhoe and go in on a Saturday when the staff isn't there, they know a little bit about the business. We can look at the P&L trended over time and determine exactly what their job costing looks like, usually even if they don't have a job costing system, or if they do have a job costing system, because you can see that the margins are less fluctuating. They're more stable. What we want to do is actually prepare that list of questions as you go in on the Saturday to understand what the operations are from the finances, because those two things should be linked. Why is it that the backhoe is only in use half the time? Or, why is your equipment, you have so much equipment for so little revenue, or whatever the relationship between your finances and that operations are. You can ask more intelligent questions if you actually get the financials in advance, look at them, try and understand, hey, what does this business do? And then ask the questions based on that knowledge. That to me is a huge power of having a CFO involved in the process, or really any finance person. I mean, you've done enough businesses that asking good questions can lead to better outcomes every time.
Well, and how do you feel about when it's obvious that the proper systems just aren't there? because it can be one of two things. It sometimes can mean there's an opportunity there that the business could be performing better, or may in fact be performing better than the current owner actually realizes.
Yes, and that's the opportunity. I kind of always advocate acquiring a mess is not necessarily a bad thing. You want to make sure, we want to spend extra money on diligence at the beginning of it to make sure that the mess is manageable. Running a mess is unacceptable, and selling a mess is a crime.
Yeah, yeah. If you acquire a mess, you should have some plan to clean it
Mhm.
up.
Oh yeah, because
Yeah.
that's where the benefit is. You take the mess and you organize it, and you make it more profitable. You make it bigger. You make it whatever it is your goal is, your vision of success is. You can make it that way, but only if you know what you're measuring and what you're controlling.
So, talking about how jobs are done and recording all this data, et cetera, we're kind of looking backward at what work has been done. How should we then extend this stuff into looking at the pipeline of future booked work? Because a lot of the times when we're looking at one of these businesses, that is the greatest expression of any kind of goodwill that might exist in the business, is the fact that they've got like a year of work booked ahead of them in the future. I've firsthand had accounts told to me by people involved in transactions about how they bid differently to fill the order book so
Mhm.
that the business would appear more attractive to lenders and things like that. In this particular case that I'm thinking about, the buyers and the sellers did that together, actually, in order to help the buyer be able to secure better financing terms. How should people be looking at the future pipeline, and maybe how can they know if there could be a danger that perhaps things were underbid in order to create a more robust pipeline to make the business more attractive?
Well, those are all great questions. So let's get the terminology kind of set first. WIP is obviously
Sure.
things we're working on now. Backlog would be things that we've contracted, things that are in the hopper, already done, already estimated, contract is signed. We just haven't started to work on them yet. And then pipeline is all the things that we're out there, in the future, kind of going to stuff that backlog. And then WIP. So, as we pipeline is furthest in the future.
So pipeline hasn't been signed, but
Pipeline
backlog has.
in my world has not been signed. Backlog
Okay.
has. And then WIP is what we're working on now. And WIP could be we could still have a year of revenue out of WIP. So WIP is a pretty important concept within that range. The number of companies that I work with where the owner, the seller does not have those numbers in place is crazy. WIP included. WIP being a pretty important component, for accounting as well as for the future health of the business. Backlog, not knowing what that is. There's a filing cabinet with the contracts in it, but nobody has typed out what those are going to look like and made a budget. So when we use these numbers, we're actually talking about just making a forward budget, right?
Mhm.
It's both the health of the business as a bucket of revenue in the future, but it's the basis for what we're going to do next month, next year, next quarter, next decade. So, using that WIP, or using all those numbers to build your budget is super key. And then there are things in the pipeline even that you might want to assume. If you know that you're 1 month out on the pipeline, and if you could sign a deal today and you're going to get revenue next month, your pipeline is super short. You got to worry about keeping that pipeline full. If you're, when I was with the flooring company, it was on multifamily jobs. It was about a year from signing to the first dollar of revenue. So we really had to keep that backlog very full. For a $300 million business, I had to have $350-400 million in backlog, or we were going to have a problem where I couldn't keep labor next year. So, the backlog was actually almost more important than the current revenue, because it was going to be the forward health of the company. And then, the last thing with that is that you can make decisions on that backlog. So we start seeing maybe a tariff coming up or a lumber increase or something else. We can actually, if we're certain for that backlog and we know what the timing is, we can actually, hedge our purchases and make better decisions so that we save money or avoid cost. You don't want to tie up all your money in inventory, but if there's going to be a 25% tariff on something, I wouldn't mind sticking it in a warehouse for a month.
Yeah, you know what? I can tell you that a lot of people have been doing that
Yes.
because there's been an incredible actual boom in trade over the last 2 months as people have tried to get ahead of these tariffs.
Mhm.
And so, you know, when you are looking at that backlog, you just said that when you were at the bigger company, you had to have a certain level of backlog. If you see that number starting to weaken, is that when people sometimes get tempted to maybe like, oh, cut their margin a little bit to try to make sure that they've got that full backlog? Well, where does this empower you, and where does it then create a bit of a danger, as far as threatening your future margins?
Sure. So it's both an opportunity and a danger. So if you're running your company, you're in the process of running the company, you want to make sure that your backlog is full, and you don't, if it's important to you to keep that backlog steady, you might want to lower some of your bids and make sure that you keep it stuffed. If you're winning too much, you raise your prices and see what happens. It's really that bid to success ratio is kind of key to understanding your backlog. But you might have some cost for labor. If you don't keep your labor engaged, your labor could leave, and labor is a huge issue in construction, right? We want to maintain labor. There's not enough of it, so we could grow. Every company I know could grow 10 times over if the labor existed, because there's enough jobs out there. So keeping your labor engaged might be, you might want to accept a job if it fits well into your schedule. That's going to lower that. It's really just about maintaining your goals for your company through those jobs. When target sales aren't quite what they need to be, slap some markdowns on something and it's going to go a little faster. When times are good, we have less markdowns, so we keep the prices high. And there's nothing different in construction.
You mentioned you brought up the topic of tariffs. How prepared have people been for this? Because I would imagine a lot of the times people are putting these fixed price contracts and bids in, and now, to your point, someone might be looking at the prospect of increases in future costs, and they might try to then buy some materials now in order to lock in their pricing. But some people don't have access to the liquidity to do that. Have you seen over time people create outs in their contracts or methods for adjusting the price post agreement to try to reflect some of these unknowns that come along? I know that this stung a lot of people too during the COVID time when for other reasons the cost of materials and lumber and stuff went way up.
It did change a little bit. The contracts used to be very set, controlled by the larger companies, the construction companies, for example. And you just didn't have an option to do that. But a lot of companies really hurt from the massive increases in cost and shipping, all the different cost increases that happened during COVID. So I think it became more common for everybody to have a little bit of an out, and that goes all the way up through the GC into the financing company that's actually building the project. So I think it's a little more common now. Of course, they still have the purse strings, and that comes with power. So if you don't have those kind of outs in your contract, you probably should hedge a little more and make sure that you've included. The tariffs are just the kind of the latest thing, but costs can increase like crazy, based on any type of supply chain disruption, war, tariff, anything. So, workers' comp increases. That was kind of blinding as well. So, hedging as much as you can and still winning the bids is the key.
Okay. We've got a whole bunch of people that have piled in and a couple of questions that have actually appeared. So I want to get to some of them. First, so we've got Joey says hello from Atlanta, and we've got Victor from Nottingham over in the UK who has given us a like, John, which is fantastic. And I would ask anyone out there who's watching, if you're enjoying the interview, please give it a like. It doesn't cost you anything, but it really does help out the show. We've got someone who's called the mechanical engineer, maybe, says he bought one of my books this week. Thank you. I'm in the process of buying my uncle's construction company. He's excited for the conversation. And his big question is, how large of a company do you actually have to be to justify a full-time CFO? I think this is a great question.
Oh,
What would you often say?
This is great. When you can afford it. The beauty of any CFO is they're going to pay for themselves. So a fractional CFO is going to cost you a few $1,000s a month. Depending on the size of company and the things that you want them to do. My firm operates on a subscription basis. So, for a few $1,000s a month, you get access to a CFO, you get a reporting package, and basically that person behaves like your CFO. And they also do that for several other companies. So kind of works out well. there comes a point, it's probably between 25 and 50 million in the construction space. It really just depends on what your trade is and what your average ticket is. Probably 25 to 50 million, and you should have your own CFO. I would say that in the construction space, there are a lot of controllers that bill themselves as CFOs. Now, when I talk about a controller is a person who both understands the process, the systems, the organization, and the accounting. So they link those two things together, and they really are very into the weeds. So I think a controller is more important in some cases than a CFO. But there are a lot of people in my space that are controllers or CPAs being CFOs. I think you should hire an operational CFO that has the experience within the industry and can help you actually run the company, not somebody that you call afterwards to tell that you made a decision, but somebody that you're actually making the decision with. And that to me is the difference in a CFO. Anytime you can do that, you should investigate the fractional, look at different fractionals and different structures of the fractionals that exist in your world. Employ one as soon as you can. They're going to be worth it. And then, there'll come a time when that person's overworked and tells you need to hire a CFO for full time. Just go ahead and do it then.
I'm constantly pointing out the difference between people who are in the accounting profession versus finance. And the way that I like to point it out is that accounting people are all about the history. They make sure that things are recorded accurately, and they are experts about tax issues and tax rules and tax filings and all that kind of stuff. And finance people are forward looking. It's all about application of resources. Where can we get the best return by putting our resources into one, two, or three different things? Is now the time to buy the equipment, or should we continue to lease or to rent it when we need it, or what have you? I would probably suspect, John, that if a smaller construction company employed a fractional CFO who was also being a fractional CFO for other similar businesses, they could be very informed, because you could actually benefit from the experience of those your colleague entrepreneurs that are going through similar things. It could really give that person insight into the business.
That's one of the major factors, one of the major benefits of the fractional CFO space. And I'll tell you, we work with a lot of construction companies that workers' comp issue that we addressed. I had one company that faced it first. So the first thing we did is we actually worked through our network and told everybody, expect a craziness. And so everybody in our network adjusted workers' comp estimating way up, and ultimately it was the same, right? They had the same issue coming up later, but we got ahead of it based on some knowledge from one of our clients. So yeah, there's a lot of benefits to the fractional CFO. I would say, you mentioned the finance versus accounting. Accounting does look back and finance does look forward, but they're the basis for each other. An accountant who doesn't, and a CFO has to have both. It is literally a left brain, right brain. It has to be 51-49 or very even between those two things. If you have a CFO that thinks too much in accounting, you're going to be focused, more on the debits and credits, the reconciling and the process, which is super important. But then you lose the forward thinking. And if you only think of the budget and the financial planning and analysis, or FP&A, you're really losing an opportunity to do your accounting right, so that you can get your systems and processes in order. You have to have a respect for either one. Each person has a skill. You mentioned tax. I have a CPA after my name, and I'm just now learning tax. We bought a CPA firm recently, and kind of doing my first tax returns now. And it's an interesting process, but it's not my skill set. My skill set is operating companies.
There you go. So let's talk about some of the bits of hype or things that people are talking about a lot. Let's talk about technology. I mean, there's a lot of people out there who are talking about new tools to manage business and to get a better handle on some of the stuff going on. What is your feedback, for example, on some of the new app-based systems or technology tools that are coming into the workplace? Where do you think people can really benefit from better technology, and where do you think it might just be a little bit of hype?
Well, there's obviously cutting edge and bleeding edge, and I've always liked to be right behind the cutting edge. So much new technology is beta tested on the clients. So you don't necessarily want to be in the front of something that you don't understand. So I would say that the biggest key to technology in your business is getting things that you understand and can make sure that you can operate. Um, everything syncs. Everything is obviously you may be using QuickBooks, for example. It's ubiquitous. A lot of things sync with QuickBooks, but the way they sync is very different. And you might, there are companies out there that do service and operations that literally don't do job costing with QuickBooks. It's a crime. And I've tried to advise them to do that as I work with clients that use those systems. And they probably will in the end, but it's really hampering you to spend a lot of extra time. So that technology, even though it's highly advertised as super slick, integrates with QuickBooks, it integrates in a way that you can't do the thing that you were supposed to do, and that's frustrating. So kind of looking at your systems and understanding what you want it to do and make sure it does that. Involving your fractional CFO in that search for a new system, making sure that that we're looking at all the check boxes and it's not just super nice in the demo. We actually think of what we wanted to do on a daily basis is key. Everybody's talking about AI right now. Everything is all AI, and my industry as well. We're going to be replaced by AI, and you'll have your artificial CFO that tells your artificial COO how to do things and but not this week, right? It's all those tools are still being shaped, and we have to learn how to use them, really from the ground up, put them into our business.
One of the things that I've started to mention to some people that really they haven't been thinking about it at all is, I've had some experience submitting bids to larger companies, like big publicly traded companies, for example, and a lot of big companies are really keyed into this. They're like, who are you, and are you successful, and can we rely upon you being around? And I think that a lot of smaller businesses don't even think about this when it comes to sourcing technology or products, where they'll see a demo, for example, they'll see some new piece of software, they'll say, hey, this could really be helpful to me. But they don't really take the time to look at who they're dealing with, because a lot of these tech companies, they're eager for market share. They've raised some money perhaps from investors to float their finances for a while. But if they're not making money, then you could put yourself in a precarious position by becoming reliant upon their tech tool, and then something happens to them. And the reason why I'm bringing this up is that there was a case just a couple of weeks ago, a big a tech company in Vancouver that a bunch of people had hitched their wagons to, just shut down. And all of a sudden, poof, like the solution that you had that you were using every day is no longer functioning anymore. I really think it's important for people to get an idea of just what kind of staying power some of these providers might have.
It's a great idea, and you never know. Even huge companies like that, huge companies like PeopleSoft or JD Edwards back in the day, gobbled up by Oracle. So you really never know what's going to be around. And the good news is that systems are somewhat transparent, and you can move from one to the other without the the way that it used to be, where you had an 18-month implementation. But I think it's important that you believe in the company and what they do, that they have some good history, and that it really works for you, that it is the thing, that's right for the way that you do your business. And then the third thing is cost, right? I have some companies that they want the cheapest system, or they want the thing that doesn't work quite as well because they think they can't afford the big system. When really sometimes it's the big system, and even though it costs 3 times as much, that might help them organize the company to make 6 times as much more money.
Right.
So really it's about that planning and that footstep from one to the other to the third that makes sense. Having a partner that understands the finances of that, and then somebody that understands the technology of that is probably key. So, I don't deal with a lot of fractional CIOs, but that could be another idea too, where you employ the idea of somebody that evaluates the technology and the finances separately.
Yeah. Well, you've been in this space for a long time. Would you say that there are some sort of commonly held ideas or beliefs that may have to be challenged or should be challenged by people in this space?
Even in the fractional CFO space.
No, I mean in the construction or project-based business space.
Okay, so when we talked about buying the businesses, it's amazing to me how many people don't necessarily they look at the business because they understand what the business does and don't look at the finances. So, um, to me, somebody that just doesn't work with the finances, that thinks all that's going to work itself out in the end, that's the hugest mistake. Whether you're buying a business and not doing a quality of earnings or doing some type of check on it, whether you're operating a business that doesn't do job costing, or know
Well,
what your margins
what
are.
do you mean? Like, I know that if I'm building foundations and charging 2,000 and they cost me 1,000, then it must be a good business just because I can see that there's some profitability. The other stuff should just take care of itself. That kind of sort
Could
of
be.
overly, surface level examination.
Well, even there, you're assuming that your $1,000 cost is really correct. What I'm saying
Yeah.
is, some people run their business by just how much money is in the bank, or whether they still have some level of profitability on a yearly basis rather than on a monthly or on a job basis. So, kind of not using the power of your numbers is the number one thing I see companies do wrong. There's a lot of data there. You can get way too organized with it, and you can do analysis paralysis if you're not careful. But looking at 5 or 6 things on a monthly basis, making sure that you have your systems and processes in order to get those numbers out, and that you focus your attention on those numbers, moving them in a positive direction each month, it's magic. You will make more money every single year because of it.
Where do you think the greatest point of risk is in these kinds of businesses, in project-based businesses? Like, is it with the customer, or is it with the staff, or is it with the systems? Like, where do you see as sort of the place where we really should be focused on making sure we have things locked down?
Well, the risk really is that your business is going to fail, and that's numbers, right? That's just the finances, cash, liquidity, all that. So, most construction companies that get themselves into a bind, it is because they didn't do a cash forecast, right? If you do a cash forecast and say, here are the projects I have coming up from my backlog and my pipeline, here's how much it's going to cost me over that time, and then you figure out what that does to your cash balance, and you look at a minus at the bottom of the cash number in that forecast, you're going to have to come up with that kind of money. You either have to extend your payables, get some extra financing, whatever it is, to make sure your company is shored up. Otherwise, you're out of money. You can't pay your payroll. You can't pay your suppliers. So, cash flow forecasting is the tool to overcome liquidity events. Then, the risk is really in the value of that forecast, right? Are you going to be able to keep your labor? Are your costs going to increase or decrease? What actions can you take to hedge any of that? Are your contracts adjustable based on some type of catastrophic pricing event? Tariffs or price increases. Those are all the individual things that you can look at within that to make sure that there's risk. But the biggest risk is that you're going to run out of money or not have the ability to do the job. Labor, I would say, is a huge issue. Labor is in every construction trade I know of, it is very hard to find skilled labor. Skilled labor is at a premium.
Yeah, but there's an interesting comment here that Neil put in here. He says, too many owners are farming out accounting to the bookkeeper, and as a result have terrible chart of accounts and no visibility into what is actually happening. I can tell you that I've seen this more times than I can count, where I'll ask a business owner to provide, their financial statements. I'll get an income statement where there's no cost of goods sold, everything's in the expenses, or something like this, and you just have no visibility into what is happening with respect to gross margins. And I'll say to these business owners, like, you set these people to the task of doing it, but then you never looked at what they were doing, and you obviously were never looking at these numbers to manage your business. How often do you see that kind of problem? Because I see it frequently, and maybe it's people don't know what they should be asking for, or they don't have any kind of finance background, to know what they're looking at is not going to give them the right information.
Well, that's it right there, right? So you hire a person called a bookkeeper, and we'll talk about the players in the accounting ecosphere in a second. But you hire a person called a bookkeeper because that person is a person you think you can afford, and your wife or your cousin or somebody else got tired of doing bookkeeping, so they want somebody to do that first. So you hire this person and they set up your chart of accounts, making some assumptions about where things belong and how, how it should look. And then they book those transactions, they balance the cash, do a few things. Books are balanced to some level, but not pretty. Most entrepreneurs don't have the skills to manage the bookkeeper. When the bookkeeper says, how should I book this? Where's the debit? Where's the credit? I don't know. What's a debit? What's a credit? Right? I run a construction company. So what you're missing there is the strategy of how that stuff should be booked to come out with something that's useful. If you're just thinking of getting the stuff in there for your tax return, super simple. Your bookkeeper is going to be great. They'll shove it over to the accountant at the end of the year. Your tax return is going to be, it's going to be fine.
Yeah. So when you see that growing ask accountant line, that you know if some of this is going on.
It is, and we actually use the Ask the Accountant button in reverse. When we don't understand transactions, we actually stick it there and make the client pull it out. So it's a useful account, but it's also a placeholder that needs to be cleared. Let's talk for a second, if we can, about the ecosphere of the people, right? The bookkeeper is usually the first person that gets hired, and they've got a bookkeeper is a person who has accounting acumen and who can do transactional work every day. So they're going to do your AR, your AP. They may have a baseball bat and go down and collect some receivables for you. They're going to make sure that your vendors get paid, hopefully on time and not early, so that we manage cash a little bit. They're going to balance your cash accounts, which is the way that you actually understand that all the transactions are booked for a cash basis. And they may actually go into accrual accounting a little bit and do some accruals and payroll and all that type of thing. So they're going to do your day-to-day. The bookkeeper is who you want to say, hey, handle this transaction. There's various levels of accountants above that. An accountant might do some more in the accrual world and do your closing checklist and make sure that your financials are more presentable than the bookkeeper usually leaves them. These are just semantics, and that's the next level up of this accountant. The controller is going to look at processes and controls within your organization and polish off the bookkeeper and the accountant and make sure that everything gets presented correctly and it's much more operational in nature. And then your CFO should be strategy. If your CFO thinks about which line it goes in the tax return, you have the wrong CFO. The CFO should be talking about what you want to invest in, what you want to organize, how you want to do things so that we impact the financials. And they should understand the accounting to direct the bookkeeper, the accountant, and the controller. Those are the people that should be involved. So when we talk about having a bookkeeper and you don't want to ask your bookkeeper, what should we invest in this week? Your bookkeeper is, paying the bills and doing the stuff. So having the right group of people involved and asking each one to do the things within their role is the key.
Yeah. We got a couple more comments here that to kind of jive with what you just said. Andy's talking here about how AI can help a business owner, but if there's garbage going in, then you're going to get garbage coming out, and you still need that qualified person to help you make decisions based on suggestions. And quite frankly, I've asked AI before to help me with things like that, and it's kind of interesting as a muse. It comes up with different ideas, but it definitely has to be sorted through. And then we have an electrical contractor who says he's owned his own business for the last 10 years and wants to know if there's any benefit to purchasing another electrical contracting business in his area. He says he's got a couple of offers to do so. Doesn't know if it makes sense to buy an existing business versus just simply expanding the one he has. I know that there's a few things that I might comment on this. What do you think, John?
Well, buy versus build is the conundrum in business, right? It's going to cost you money to go out and get those clients from the electrical contractor next door. It's going to cost you money to do that. The question is, would it cost you less to buy their business and integrate it? When we talk about synergies between your current company that you run and the next thing that you're going to bolt onto it, really, it's about making more money. It's about making more. A bigger operation. You could, for example, save on admin, right? Overhead and admin. You can have one estimating department between the two, or however that all fits together. Buying the business within the same geographic sphere is a good way to consolidate your power and consolidate your organization within that sphere. If you're just going to run those two businesses separately and not think about things like synergies, probably all you're doing is taking out competition, which is fine. but you're not getting the full benefit of that. When I was in the tire industry, we were buying tire stores. And so we would go do geographic areas. And so you don't want a tire store right across from another tire store, because that wouldn't make sense. You're just eating your own, you're cannibalizing your own market. But if you're in Florida and buy a chain in Georgia, and then South Carolina, and then North Carolina, now you're a regional player. And that's where we went from, Florida only to 46 states, 3 countries, was specifically in that geographic expansion. So there's a lot of ways to think about expansion and bolt-on. If you're not thinking about the strategy of that and making a roadmap to be more profitable and more secure, I think you're doing a disservice. But
yeah.
In this particular example that's come up here, I've often seen that businesses buying other businesses will actually put less of a value on a business that happens to be in the same geography, because what the attitude often is, hey, if they just went out of business, I'd get most of their clients anyway.
Mm-hmm.
So why would I pay for it, right? And businesses will almost always value more the business in the other geography, like you just gave in your example with the tire stores, right? The next state, the next county, the next city, or what have you. But the reality is that if you did end up buying another electrical contractor, Laguna Electric, in your same geography, you probably would not maintain it as a separate business. You would probably just integrate those employees into your existing company, and probably create one workflow and try to get those synergies, which then begs the question, why are the customers doing business with the competitor and not you today? Because if those people, for whatever reason, don't like you, if they're doing business with that other company because they heard something bad about you, and then you buy them and just integrate it into your brand name, those customers are probably not going to stick around. They're going to, go looking for somebody else again. So it is a really difficult decision to make about buying a local in-market competitor, and you really have to examine the opportunity and see if it really does make sense at the end of the day. I know it's not an easy thing to answer.
There has to be a roadmap. It's very interesting. When some people don't want to deal with the mega corporation, right? So in the funeral home industry, then it's totally outside of what we're talking about now. There are huge companies, and you would never know there's huge companies because the face of the company is something that that has a name that's 100 years old. I think it could be the same with Laguna Electric, right? If the other electric company is somebody they're calling because of that name, then you want to keep the name, but you homogenize the back operations, and you have one company that has 3 names. There's 100 ways to do it, and it really matters as to what the value of that company is. Now, if the value of the company is in those customer relationships, and you'll never get those customer relationships under your current company, it might be worth it to buy them and then service those companies really well and create one company that has these new customer relationships. But in the opposite side, those customers, as you say, could just go away, and you bought a cash stream that isn't there anymore. That's the danger.
Yeah. In something like electrical work too, there really are 2 different kinds of contractors. There's the service work companies that are going out and visiting homeowners and businesses to do repairs and things like that. And then there are the people that do sort of new construction work. And they really are very different. The one that does service work is the one I would want to own, because you have people calling the company because they know the brand, or they've got them in their phone, or what have you. When you're doing work for a general contractor, and correct me if I'm wrong, John, but most general contractors have an idea of what it should cost to get something done. And this creates a sort of barrier or limit on the margins that subs can charge, because if they try to charge too much, that the general contractor is going to move that work to somebody else.
General contractor relationship like that is very relationship based. So they're going to know the people that are bidding. They're going to know that they can trust them. Similar to electrical, because I work with several electrical companies, both low voltage and regular electric. I had a roofing company that was not winning jobs because, and we found this out through questions, but they weren't winning jobs because they were too low. Literally, they were okay with the profit margin that was unacceptable to the general contractor. And once they raised their prices, the general contractor had more faith they could actually do the job. And they started getting these, $250,000 jobs more and more and more. So
they were worried they wouldn't be able to deliver.
Yeah, so it was actually the opposite. They actually made more money with the general contractors because they had that relationship, and now they're the first call. Um, they also are super easy to work with. So not a finance thing at all, but when you can fix a problem for a general contractor without a bill or without a problem, you go back and fix somebody else's work even. It really makes a name for yourself that you are the person who can handle things, and it gets you that next contract.
Mm, that's a great insight. Thank you. All right, we are hitting the top of the hour here, and so we're running out of time. If people are interested in learning more about you, or potentially even talking with you about some of the stuff that you do to work with construction businesses, how can they reach out to you, John?
My website is at ppsfinance.com. PPS is for people, process, systems, because I believe that those three things have to happen in that order to be successful. So ppsfinance.com. I am John, John, at ppsfinance.com. And those are the two easiest ways to reach out. I love to help people. So, if we can help you with CFO service, I'll talk to you about it. But even beyond that, answering questions about finance, helping people to get to the right resources is key for me, as I know it is for you, David. So
Awesome.
ask a question.
Thanks so much for coming and joining me here today. And thanks for everyone who tuned in live. There's a whole bunch of you there. Please hit the like or share button. Help spread the news about the channel and the great conversations that we have over here. And we'll see you all next time.
So, how can you learn more about buying, selling, financing, and managing small and medium-sized businesses? Easy. Go over to my blog site, davidcbarnett.com, where you can learn more about me and how I work with my clients. You can learn more about my books and courses that I've prepared for you. You can find out how to subscribe to my email list, the YouTube playlists, and more. There's literally hundreds of hours of content there, all for free, and I'd love for you to be my guest. Special thanks go to Mark Willis at Lake Growth Financial, today's video sponsor. Mark helps people better manage their personal and business finances through the Bank on Yourself insurance strategy. This is something I've done personally and I've seen others use it successfully for years. Go to newbankingsolution.com to find all the interviews I've done with Mark and learn more about the advantages of these programs. While there, sign up for a free consultation to learn what this solution might look like for you.